Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Environment. Here's how we use, the global macro fundamentals from the top down to try and define the environment we're in, the global macro environment. And these are the environments we've been in, and this is currently the environment we are in. And let me give you an example of that, more delineated. This is where we were before the credit crunch. Demand was hot across the world. Credit was flowing. Derivatives were being created everywhere. There's asset bubbles expanding all over the world. The U.S. dollar, IWP, stands for implicit weak dollar policy. Before the credit crunch, we know the dollar was in a bear market. Going down from 2002, and lo and behold, 2007, 2008, the dollar, bounces up on the credit crunch here. So we moved from this credit boom to credit crunch. What happened? The U.S. dollar rallies because, as I said before, money had to come back in the U.S. and hide. So we went from big credit boom era to the credit crunch era, and that was a simple understanding that demand started falling off the table across the world. Credit was frozen. That was the big problem in the world. Credit markets just totally were almost destroyed and seized up. Why the central banks had to do what they did. We had deflating asset bubbles all across the world. So we went from risk appetite, everybody fat, dumb, and happy, and moving out to all the risky assets and stretching for yield, to a very quick period of risk aversion. And the dollar moved from implicit weak dollar policy. When I say implicit weak dollar policy, what I mean there is the fact that the U.S. government, despite saying we have a strong dollar policy, blah, 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 they like a weak dollar because it tends to pump up financial assets. And the goal here is to try and keep this symbiotic relationship with the U.S. And China alive to a degree. I won't get too far into that. But in general, for some reason, and I shake my head, the U.S. thinks a weak currency is beneficial to the U.S. Just because of the fact it pumps up global asset markets and tends to help trade a bit. But since 2003, a weakening currency has not helped trade whatsoever, and there are reasons behind that. But in general, that's the policy that we had before the credit crunch. The market put an end to this policy for a while when we got a risk bid in the credit crunch. And now we're back into this third environment, which really is this idea of, global healing going on right here. Part of the problem is we still have low global demand. We had hot global demand before. It went from hot to frozen, and now we have low. No doubt it's improving slowly, and the numbers are getting better, but you have to say global demand is still low, especially given that the U.S. consumer is still in the doldrums, and he's the biggest part of global demand. Credit is no doubt, we're healing, and we've seen massive healing in the credit markets compared to what happened during the credit crunch, but we're very different from what went on here during the boom period. The difference is we're not seeing any lending to the real economy. That's very different than it was before. Small businesses are cratering. We saw 2.5 million bankruptcies last year, over year on year, in small businesses in America because they're not getting any money. They're not getting any money because banks have raised their lending standards. Banks are hoarding the cash because they can borrow at zero and buy risk-free treasuries at 3% and just make money on their balance sheet all day long doing that trade. So why lend it out to people that might not necessarily pay it back? So although the credit is, you could say, flowing again, it's flowing into the financial sector but not getting out into the real economy. That's a big change during this period over here. We're seeing asset bubbles expand in the same way, exactly the same way that we saw before. We see massive movements in the S&P. Emerging market stocks are up 75, 80%, some up over 100. I think Russian stocks are up 120% this year. China is up around 80%. After about an 8% plunge today, 72% in China. So we're seeing this risk appetite return, but there's still a question mark in here, and that's why this environment's different. And I think if you do your global fundamentals and you just understand these basics, you can say, hey, this environment is a little different still, although what we're seeing is the same type of movement in asset classes. We've seen the U.S. dollar going back into a bear market. We've seen a massive move up in the financial markets. As I said, the U.S. dollar, again, is in this weak implicit dollar policy. That's the consensus view. That's the current view. That's why the dollar's falling. The U.S. Fed has created massive amount of credit to save the globe and save other central banks around the world through swap lines during the credit crunch, and they continue to pump it out into the world. So the environment is similar in one area, but quite different in these other two areas, which that in and of itself tells you something. It's a little bit of a red flag, and it says, well, I'll get to what I think it says, but I think, as you can see, just doing your fundamental top-down global analysis just on this basis gives you some information. And it says, yeah, continue to ride this trend of risk appetite, but be careful here. Be careful, because these things have not rebounded. And because these things have not rebounded, what it tells me is that we have a massive, I think the word can be massive. There's always a disconnect between the financial economy and the real economy. If you look at the economy, people say there's the economy, but I think from an analytical standpoint, you're much better off if you think of the economy as two parts, the financial markets and then the real economy. The financial markets, Wall Street, where we invest, asset markets, those type of things, the real economy, Main Street, where we work and live. And because these things, we haven't seen credit get to the real economy, and we haven't seen the consumer employment improve, we haven't seen the consumer rebound, we're seeing disposable income fall, all those things, and yet we're seeing soaring financial markets again. That's a disconnect, and that to me says there's another dollar scenario that could be in play, and it could be a major rally in the U.S. dollar based on this risk, on what's called this risk bid, the same type of risk bid that hit during the credit crunch. But one of the reasons we think this scenario could be very different is the fact that as we went along, our asset were booming, and everybody's happy from 2002 to 2007, housing prices going up, stock prices going up, credit crunch hits. We're still killed on the real side of the economy. Sure, our 401ks are returning on the stock side of the fence, but our housing is still in the doldrums. Our jobs are in trouble. If we see another major risk event that drives stocks down, I think you're going to see a big change in sentiment in a very, very big way. That means you have what's called a long-term risk event and not just a short-term risk event that's hit to the stock market. And if you have two of these hits, one the credit crunch and then another risk event here, I think that changes the dynamics in the global economy, especially towards the dollar, and then money starts coming back in a big way and doesn't go out again for a while. So there could be a risk event, a small risk event. The dollar maybe rallies and then goes back into a bear market. But if we get type of long-term risk event, it changes the dynamics. The third scenario is this idea of a valuation rally on central banks taking money out of the markets, and I'll explain that on the last slide.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.